welcome. For all those who are joining, today's webinar is on effective budgeting strategies and best practices, ensuring your property is financially sound. Gianna, I just want to go ahead and introduce all of our speakers. First and foremost, I have Avi Zanjirian, who's a CPA. Avi has been a valued member of Czarnowski Beer since 2007. Avi oversees the audit staff and is heavily involved in each client's audit process. Avi's skill set allows for the enhancement of the audit of the firm's audit engagements, and his friendly nature makes rapport building with firm clientele effortless. In addition to ensuring that all current procedures and standards are followed, Avi's stellar ability as a mentor improves the performance of his team. I can speak personally, Avi. I think your firm audits, plenty of our buildings at AKAM, so we're very familiar with your firm and your excellent quality of work. I'd also like to introduce my colleague, Meagan Mooney, who is our Vice President of Finance at AKAM. Meagan brings, many years of experience in the field, definitely over a decade, Meagan, right? Yeah.
Times 3.
So Meagan has prepared many budgets for condos, co-ops, and everything in between, and is extremely knowledgeable. We're really looking forward to your insight today, Meagan. And my name is Maman. I am Vice President of Business Development here at AKAM, and I am really honored to be your moderator for today. One of the things I really look forward to is whether you're a new board member, whether you're a treasurer, whether you're someone who's just looking to learn more about the budget process. We really hope that this webinar offers something to everybody today, and we want to just put more tools in your toolbox as far as being a knowledgeable, informed decision maker of your building. As far as our goals for today, as far as an overview for today's agenda, we're going to go over what are the goals of your annual budget, what is the budget process, what's new as far as maybe new regulations or things in the field that would impact your budget this year versus previous years. And then best practices, general best practices when it comes to your budget process. And then we will try to wrap things up with a Q&A, but please, at any point during our presentation today, please feel free to type in anything into the Q&A box, and we will, if we can, we'll try to weave it in organically into the session as well. Okay, so without further ado, Avi, I'm going to go ahead and pass it on to you to discuss what are the goals of an annual budget.
Okay, thank you, Gil. Thank you for that intro. Good to see everybody from AKAM and everyone in the participants on Zoom. It's always good when starting any project or any budget for a building is to understand, like, what are we trying to get to, what's our end goal. And the one thing I always try to remind our clients is, and it's a separate question in and of itself. People ask us, are we non-for-profits or not? You're not. Most co-ops and condos are not, or if all, you're usually incorporated or associations. But the mindset should be that one of a non-for-profit. You're not a Fortune 500 company. You're not looking to turn profits. You're not giving out dividends to shareholders or to unit owners. Your goal as the board is to make sure that your revenues cover the expenses from an operational standpoint, and to make sure that any capital needs or capital projects that are coming up are also thought through, not just for the current year, but for future years as well, looking out into the future. One of the other goals you take is the opportunity. We're going to talk later, I think, about just how this is going to be a working document for the whole year, but an annual review. If again, you're not in the position right now to be looking at your budget every so often, it's an opportunity to kind of step back and look at the year and say, how did we do? As an annual review of the year, usually around now, we'll take a look at the numbers and look forward into the future. But it gives you that opportunity to step back and see how everything's doing to help you prepare for the budget process. More basically, it's the tool to set carrying charges. Those, that dreaded or, letter from the board of, it always starts off, the board has diligently looked through the expenses of the building, and it's like you're waiting, is it an increase or not increase? How much, what percentage? It's really to set the carrying charges for the year as to what the building needs to cover the expenses, as we mentioned. If you don't take a look at it and you just keep things the same every year, you're not helping yourself. And you're not helping the building. And lastly, planning for the future, more on the capital side. We mentioned it a minute ago, but you want to take the opportunity to, maybe we are turning a profit. Maybe we had a good year, or we just signed a new commercial lease and we have an extra couple of bucks a year. What could we do with that money to help us plan for the future?
Excellent. Thank you for that, Avi. And Meagan, anything you wanted to add on top of that? What are the goals of the annual budget? Anything?
Yeah, I think Avi said it pretty well, that it is the tool to set the carrying charges. And I think it is very important to be realistic when doing this. Consider if you have outstanding invoices, things like that, to make sure you're taking a realistic picture. For the most part, if there's mostly board members, you have a fiduciary responsibility to look at this as a business, and keep true to that.
Absolutely. Excellent. Okay. Up next, we're going to cover the budget process. So to start us off, Meagan, you want to go through, I guess, the expenses portion of the budget process?
Sure. First and foremost, I think it is important to maintain a review all year of your expenses. And the important part of the budget process is to actually tee yourself up for the following year so that you are set up for success in the next year, to appropriately budget line by line. You don't want to get to a place where all of a sudden you have an unexpected water treatment that is an annual fee anyway, or something like that, something you've already contracted to. So you want to be really realistic and look at every single line item. It's a great time to review all of your expenses before the annual audit is coming up. So when you're doing your budget, typically around 3 months left in your fiscal year, you want to be looking at not only your predictable expenses, which would be, what Gil has listed here, the payroll. You generally have a pretty good idea of what your payroll expenses will be. Insurance, we're going to talk about later, because normally you might have a good idea, but the insurance market has been a bit wacky. Corporate taxes are usually pretty steady. So there are some expenses we can get really close to predicting. There's other items that we look at: historical. We use, usage for energy, and you want to make sure you have a couple of years of that. Sometimes you have to take into account things that happen in life, such as COVID, when there may have been reduced, or increased vacancy with the building. So you may have had reduced usage. And on the flip side, Con Ed wasn't reading certain things. So the year after, we saw a lot of increased adjustments. So you have to take some of that into consideration. It's not always just a flat historical look. You want to make sure to be realistic and be aware of what's been going on. For co-ops, it is, and condos actually, it's really important to make sure you look at your real estate taxes and make sure your tax certiorari attorney is always fighting for your reduction of values, to keep up on that. The more you hold people accountable, even your attorneys, the more you'll get. The squeaky wheel always gets the grease, so we say. Also, maintenance expenses. That's a big part of the budget. It's not usually the biggest part necessarily. Usually payroll, taxes, insurance are the big ones, but maintenance can be a really crucial part. And sometimes it is one of the few areas you may have some control over. So it's really important to take a look at your maintenance contracts, make sure you're getting the best price for the service, make sure you have the appropriate service. I've been in meetings where boards say that they think they need more exterminating, which is very understandable. So you make a deal with your current provider and get it done twice a month or something. So that's something you definitely want to keep a look on as well. as I said before, setting it up for the following year is really important. So you want to make sure we do a realistic look, make sure we make accurate forecasting on these line items, so that when something always does come up, but when something does go awry, you catch it right away and either know why and it's reasonable, or you need to find out why. So that's important to track as well.
I
That is it from me on that.
Meagan, I've heard from you before as far as so we have here, we listed payroll as a predictable expense. But I've heard of buildings who complain to us, hey, it's halfway through the year and my payroll expense is way higher than I thought because we have a lot of overtime. Is there anything we do at AKAM, or is there anything that you advise boards to do to limit overtime exposure?
It's one of those things that we do recommend kind of in a lot of places. The more you hold people accountable, the better off you'll be. We do a monthly overtime analysis. Anything over a certain percentage has to be explained in writing. So if you hold people accountable, you may tend to see a reduction in that number. Because overtime can get out of control. If somebody knows that they're not being watched or held accountable, people can take advantage. So you want to make sure to keep that under control.
Okay, excellent. Thank you, Meagan.
If I could add just one thing onto the expense side,
please.
So what Meagan just reminded me of something. It comes to some of the areas on the expenses, especially in the maintenance side. It's obviously the contracts. You have a contract, you know what those are going to be. You want to take the opportunity. Obviously, if you're happy with the vendor, even if you are happy, you're not happy, take a look every so often to vet out your options. And I tell clients, even for our accounting firms, your attorneys and stuff like that. It doesn't hurt to ask if you're happy, but if you're not happy, it's to kind of look at those areas and just see if we're getting the best pricing as possible. Obviously, that could be a very cumbersome process as well. You're not looking to save $1 or $10 on a $3 million budget. That's not going to make a difference. But the other areas also, like Meagan was saying, in terms of accountability, in areas on when it comes to repairs and when it comes to supplies, when you're meeting each month, if you're meeting every month or every meeting quarterly with the board, taking a look at those areas and making sure that they're on budget, because those I've sat down, and I'm sure Meagan has so many meetings after year end or 3 quarters of the year. Why are supplies so high? And like it's September, October, and it happened in January and February, and it's just at that point it's hard to go back to fix it. Like we've said at the beginning, this is a working document throughout the year. You set supplies at $50,000. If you're ready at $50,000 of July, you need to understand why that's happening, and that'll help you for the future. So those were kind of the two things I wanted to add on to that. Excellent.
Yeah, absolutely. It's you guys keep bringing up. It is a working document. It is a way for boards and managers and treasurers alike to sort of measure the building's financial performance. Hey, here's the monthly variance as far as our monthly reports that we give to our boards. Hey, what did we predict we would spend versus what did we actually? That's something that that there's a reason we provide it on a monthly basis for that purpose. So Avi, if you could just walk us through now the other side of the budget process, which is the revenue side.
Right, I will do that. So it's easy, right? We say, oh, this is how much we have to spend for the year. Now we come back and say, well, how are we going to pay for all of that? And that's kind of where that's really where the budget process is the harder part. Okay, we know that all the expenses are going up. How are we doing that? So a couple of different tidbits is it doesn't always have to be an increase in maintenance as the answer. Sometimes there's smaller buildings, there really is no other revenue generators, but make sure your revenue generators that are there, for example, move in, move out fees. it's been 12 years since it's still at 250. Maybe it's time to move it up to 350 or 450 or 550, wherever it might be. That obviously within the market, talk to your managing agent. You know, are we collecting all of our chargebacks? Right. So another point, going back to the look back piece of the budget, you look at professional fees or architect fees and you say, wow, we had $10,000 of architect fees. I don't remember us doing any projects. You dig into the detail, you realize, oh, these are all alteration reviews. Everyone in our building is doing renovations. Per the building's policy, that's supposed to be charged back. Did we charge those back? Did we recoup that money? And those are all those types of revenue sources, which again are small, but it can add up in helping looking at those each year to understand what they are. Are they being charged back? Are they being billed? Are they there? Maybe you have fees that are common in 90% of buildings that your building isn't charging. And if you do an analysis, if we charged this fee, let's say move in, move out fee, or a maybe a storage fee, a bike fee, whatever it might be,
Pet fee.
Yeah, exactly. If you had done something over the last 5 years, we could have generated an extra $10,000 or $20,000 a year. That's $10,000 or $20,000 that would help the building's operations. So that's kind of the little piece. Obviously, if you're a building that has commercial income, a lease, multiple leases, one lease, two leases, whatever it might be, make sure, obviously, usually those are 5 or 10, 15-year leases. They're with locked in increases. But a lot of those commercial leases will also have chargebacks for escalations. Let's say real estate taxes. Are you charging those back every quarter, every 6 months, once a year, however it might be? Do you have a clawback for utilities, for water and sewer? Whatever that might be, make sure that anything that's in the agreement that may have gotten lost across the way, along the way, is being addressed. That's more like on co-ops that have commercial leases. We have this a lot with a lot of condominiums that are being built in the last 10 or 15 years, where the condominium has a commercial unit owner. So they're owner just like the residential unit owner. So they own the space. Built into the offering plan is an expense allocation. They're supposed to cover X percentage of the super salary and Y percentage of the elevator, exterminator, however it might be. They have access to the elevator, so they're responsible. They're not, some will say they don't have access to the elevator, so they're not responsible. Whatever it might be, it's all usually laid out in the newer budgets, in the newer offering plans that have been put out, very detailed Schedule Bs with a sample of what the budget should look like. And they tell you which expense line items should be allocated to the commercial unit. I know that AKAM has, when we look at budgets with AKAM, with other management companies as well, that'll be part of the budget process. But if it's not, make sure that's there, because you need to reset their common charges just like you reset the residential common charges or maintenance. So it's an important piece to look at that. Request a lease abstract if you're not able to do one on your own. Maybe there is one, maybe the broker put one together, maybe the lawyer put one together, to make sure you have a kind of a one-page cheat sheet of all the different items that should be charged back, so you could go through it. That's helpful. And lastly, we put it last because it kind of is the last line of defense is obviously the maintenance and common charges. They need to reflect the true expenses, and that whatever that might be, if it's a 5%, a 10%, 2%, 1%, looking at after looking at all the other identifiable sources of revenue to see what your new maintenance or common charges would be for the year. So that's what needs to be there, and also I think Meagan mentioned it before. Be honest with yourself. If you don't, you always, some buildings will say, we only want to increase 5%, but you really need to do 10. Be honest with, is that the right move for the building or not? We said we wouldn't go into war stories as such, but I just wanted to
please.
I just wanted to touch upon one story that comes to mind where we had a building that had signed a bulk cable contract for 5 years. From whichever vendor, doesn't matter. I don't remember. And unfortunately, the building, the union owners didn't sign up. So they were literally, I think they were paying about $15,000 to $20,000 a month as a bulk package. If everyone had signed up, it would have been you know,
Worth
it was a great deal. For whatever reason, not everybody signed up for it, and I think there was maybe out of the, you know, at $100,000 of expenses, I think they recoup maybe 20 or 30. So they were sitting there with a $70,000, you know, nut, more than a nut in their expenses for 5 years. They were locked into, you know, and whatever the case may be in this situation, it wasn't really addressed. And it hurt them on an annual basis. I think, you know, the 5 years have passed, they've moved on. But that's something that, you know, you need to deal with it. You know, either it's maybe trying to cancel the contract because it's not working for you, or assessing or increasing maintenance to cover it. That shouldn't come out of the building's reserve account. That's hard-earned money the building gets for projects. It's something, you know, that you need to just be honest with yourself and the board has to be honest with themselves and the building as to, you know, make sure they're doing their due diligence and their you know, fiduciary responsibility to make sure their revenue is up to par.
Absolutely. Yeah, that's a really great practical example. You know, a bulk package that actually backfires on a board. Unfortunately, that's not a unique story. I've heard something like that as well. And then I just wanted to add my 2 cents regarding the lease abstract. That was my my contribution to this. I as a former manager, I relied on these. I was not going to go through whatever it was, 20, 30, 40-page lease and amendments every time to find what the economic points are. I think it's extremely important for not only a manager, but also for maybe a board member, a treasurer, to also have a copy of a lease abstract. You know, it's something that we provide our clients, we prepare here at AKAM. And, you know, just so that you have a working knowledge of what's owed, you know, common area maintenance charges, what is the, you know, if this breaks, who's responsible, etc. Having a cheat sheet like that is extremely important. And also for being able to predict your revenue. Hey, what kind of escalations, you know, does our commercial tenant have in the case of a co-op that owns their commercial spaces? So yeah, that's all great info. Meagan, anything you wanted to add to the you know, as far as revenues?
No, I
Okay.
can start off on the capital planning.
Yeah, please.
I do find it really important, not only when you're looking at your operating expenses, but it's also an opportune time to sort of start planning for the future, whether it be the next year, 5 years, 10 years. It really is becoming more and more important, especially in New York City, where you have all of the local laws. Local Law 11, what cycle are you in? Did you have a little bit of work or did you do a lot of work? Will impact your next cycle. I saw somebody had mentioned Local Law 97 and the carbon emissions. That's another thing to take into account. What do I need to do to get in a better lineup for that and avoid penalties? So it is definitely something you want to, you know, take a look at, not just for what, you know, in this case, 2024 would be the next budgeting cycle. Not only just what are we going to be doing capital projects for that year, but what are we going to be doing in the next few years? Because it really may impact some of your operating costs, such as, you know, mortgage interest. Are you able to refinance to start building towards the next roof or next local law project? Are you going to start to build in a reserve replacement line, which I'm a big fan of that. I think it's a great idea, even if you just start at 25,000 a year and have a reserve replacement line in there. Yeah, we agree on a lot, Avi.
You gotta start slow.
You got to start slow, because you can't just go to 10% of your line item, you know, of your carrying costs all of a sudden in 1 year usually. But it is important to start taking a look at the multi-year, what you're going to need. The general rule of thumb for reserves used to be about 3 months. Now people are recommending to have about 6 months of your carrying costs. So whatever your operating expenses are total, divide by 12, multiply by 3, that would be the low end. And if you multiply by 6, that would be the higher end of what the rule of thumb is. That does not take into account that next year you're going to need a full roof. So that's where it becomes really important to start planning ahead see what your reserves are, make sure you're planning, forecasting what you're going to be doing in the future. I think that's what I had to say.
Avi, anything you want to add as far as capital planning?
Yeah, I think the going back to how much to answer the question, I have a little bit of a different take. Not that I disagree with Meagan on the reserves, how much should a building have, but there's no rule of thumb. I wouldn't want anyone to say, well, they can't. Meagan or Avi said we should have 3 months of common charges and reserves, and then that's that we check the box. But you have a $2 million facade project coming up next year or in 2 years from now, because you filed SWARMP, which I always forget what it stands for. Safe with some repairs.
Some repairs and maintenance.
There's a program. So if you did a local 011 inspection and you filed SWARMP, so in the next cycle you're going to have to address these items. So 3 to 6 months maintenance is nice, and it's a nice reserve. It's bulky. But that you have $1 million of work to go up to that's coming up. That's what I think your goal should be. Look out 5 years. Will I need $1 million? I have 500. How am I getting to the $1 million? Or I have $1 million. My needs are only 500. How do I preserve the $1 million? Or build, incrementally build it up. We don't have to kill the owners with assessing them or putting in a big reserve allocation in the budget. But let's how are we going to maintain that? And you see that in different buildings, that some buildings that every time there's a project, they're just assessing. And then you have other buildings that have other sources. They've planned it out. They know, for example, I know we're going to talk about it later about transfer fees and flip taxes. But they know they have some units on the market. That money's coming in. They're going to allocate that money to this project and that project, and you see how well thought out it is. And a lot of these buildings, they don't assess. They don't end up having to do an assessment because they have a way to plan for this. And yes, it's coming out of your maintenance or your common charges. You're paying it, but I think paying a $30,000 assessment over the course of a year is different than okay, maybe I have a 2 or 3% increase in my common charges each year, but that helps build a reserve account that I know for the future. And I think that really kind of is the important takeaway. If you need to use financing, so you have to, right? You have no flip tax. You can't build into your reserves, or the projects are too great that it won't do anything. Then when you're looking at financing, make sure you have enough taken out, because we've both in situations where buildings will normally come up in a co-op, for example, and condos now as well, will take out a loan that will mature in 10 years, and they'll have an opportunity when you're to take out more money. When you're getting up to that 10-year mark, make sure what the next 10 years or 5 years are going to look like. Many situations where they took out too little, and they blew through all the proceeds. And I know interest rates are higher, so it's a little bit more onerous on the building. But if that's your only way to finance projects, it's definitely more affordable for the building than assessing and doing a flash assessment. The other case, which I only have one case that's happened, where a building took out too much money. They just said, "Oh, let's take out as much as we can," and they increased their debt $10 million just because that was what they could take out. And interest rates were lower, so you're not making money. Now it's a different story, because you're getting better rates from CDs and other marketable securities. But don't take out too much. Don't increase your maintenance to have a reserve account. That doesn't always necessarily work. And then you could always have a line of credit. Some buildings bank on it. They say, "Oh, we'll draw on that." But when we talk about the prime rate later, you'll see that's really not the most financially savvy move these days. If you're planning for that, it should be kind of more like an emergency fund. Absolutely. So those are my points, the takeaways on the capital planning.
Excellent, amazing. Thank you, Avi. Okay, up next, what's new? Additional things to consider. Every time we do this webinar, we try to find, okay, what's the topic of the day that, what should boards consider? What's different this year than previous years? And so I guess either Avi or Meagan, whoever wants to get us started on maybe the insurance climate. Meagan.
Yeah, unfortunately, the insurance climate has been really tough for properties. Last year we saw a huge increase in the umbrella market. About half the carriers that normally would write those policies pulled out of the market, which just led to the market really being turned upside down. People saw tremendous percentages increase in the umbrella market. This year, we're expecting to see increases of similar proportions for property and liability. Because of increasing building limit requirements and the increasing cost per $1,000 of coverage, the property and liability premiums we are expecting to see go up. As part of our budget process, we start with certain assumptions, and this is, I think, one of the first years we're actually going to be budgeting on an individual policy basis. We're not just lumping a 10 or 15% on the insurance as a whole. We're actually going to budget by policy. So, for instance, crime really hasn't seen a giant jump up in percentages, so we may not budget very high on the crime policy. Directors and officers, it depends if they've had claims or if there's some potential litigation, then it gets expensive. And again, umbrella has been ever climbing, it seems. Cyber policies, that one has been all over the place. That is a tough one to determine. The brokers that we reached out to had been experiencing 20% increases and 20% decreases. So they saw both sides, and there doesn't seem to be a rhyme or reason on those. Those aren't tending to be the bigger policies. The bigger ones really are the property and the umbrellas. So unfortunately, we are still seeing increases on those. We do recommend to keep on top of bidding those things out to keep your costs within control. So that's what I have to say on an insurance climate.
Excellent. Thank you, Meagan. Sorry, I was muted there. I appreciate that insight. Yeah, it makes sense now breaking out insurance into all those categories and instead of like you said, slapping a holistic increase on it. Prime rate. Avi, I think prime rate was something that you brought up earlier, as far as, I guess, lines of credit.
Yeah. So, and not only the lines of credit, but also new mortgages. But it was fascinating. We know where the market has been, but it's fascinating when you kind of look at it here, where we were in 2020 3.25, 2022 to 5.5, and now where we are in 2023, we're 8.5%. That changes a lot, especially in maybe you could say for an individual, it's not so much, buying a house. Yes, it is, but it's not when you're looking at millions of dollars on a co-op or condo project or financing. That really could make a big difference in the budget. So where, like I mentioned in the last slide, a line of credit may have been an option, or kind of like, oh, we'll draw down and pay it back. We'll draw down and pay back. It still may be the best option available to you, but just take into consideration that their interest rates and the lines of credits are variable. So drawing, you might have, and also something to think about also, you may have drawn down in 2022 when it was 5.5. You probably haven't realized, or maybe you have realized, you should realize that, now you're on that same amount, since you haven't paid it down, if you're paying 8.5% on that same drawdown that you were paying 5.5% for before. Yes, these are, deductible expenses, and they get passed through to the unit owners as part of the tax deduction letter in a co-op. Condos are obviously not the same, not treated the same way, but it's just something to consider when you're looking at this. When financing is your only option, making sure that you take a look at where interest rates are and budgeting for that as part of it, because it has significantly changed over the last couple of years.
And then interest income.
Yeah. So on the flip side, interest income has been great. We've had a lot of buildings, and I'll make the disclaimer: if you have a significant amount in reserves and it's sitting in a money market or some kind of, I have, I don't think AKAM banks with Chase, but there are a lot of managing agents that use Chase Bank. Chase offers nothing, and for a money market or one of these, or any, obviously not for the checking. So there's opportunities to build up reserves with this, which is kind of my goal here. Goal of my talking point here is the interest income obviously is important to take advantage of the higher CDs. I think CDs are outperforming T-bills and treasury bills today. I think last year when we spoke, the T-bills were a little bit on the higher end, but I think the CDs have really are overperforming. So make sure that you are doing whatever you can. Talk to your managing agent. Invest your reserves in any high yield securities. Obviously, I do not recommend investing in stocks. Let's go back to our goal. You're a not-for-profit, right? You're treating yourself like a not-for-profit. I've had situations 2 years ago when the stock market took a dip, where a building was sitting with a ton of money, and they didn't have projects for years. And I kept saying to them, not that I need to say that I was, warning them, but they kept saying, you really should pull it out. It's really not the best thing to do. If you have a project coming up and you need that money and you lose it, and both those buildings, they ended up having a project to do when the market tanked. They each, I think, lost about $250,000 in realized gains. And obviously you can make the argument, well, it wouldn't have grown that much if it was in a CD. So they didn't really lose anything either. However you want to, I'm not going to make that argument, but you want to make sure that you're putting the building's money, which is not yours, which is all of the owners together, in high yield, but conservative positions. And please don't use it to offset operating expenses. So we have, now last year you may have earned about $10,000 in interest income. This year might be closer to 50, 60, 70, even $100,000, depending how much you have there or more. That shouldn't offset an increase in maintenance. That should be, you're building your reserve account. That's another tool that you could use today. Hey, we don't have a flip tax. We can't allocate in the budget, but we got $2 million in the bank. We have no projects coming up. If we invest this money in a couple of CDs at 5.5%, I've seen, we can make X amount of money over the next couple of years and build up a reserve accounts for a future project that we know is coming up. So that's really where, I would push that. That's where I'm pushing with the interest income. So please, A, conservative investments, and B, don't use it for to budget and offset operating costs.
I'm gonna echo on what you're saying about being conservative on your investments. It's hard to explain to your owners at an annual meeting when you've lost actual principal on an investment. They don't seem to be as forgiving on your earnings from the last 5 years when they see a loss in 1 year on the actual principal. So have to agree with you.
Absolutely. And Meagan, I know we've been asked by boards before, hey, what about what would you do with the money? And I know we've said, okay, well, we've seen typically boards will buy staggered CDs, so that it's not all one expiration date. We don't have to wait if a CapEx project comes up. It'll, that money's available to us. T-bills.
Staggered maturities is definitely a good way to kind of map out your money. So you always have something rolling in the near future. Things do come up that you have unexpected, expenses come up that it might not technically be a capital, but you have a huge plumbing riser break or something that you need money immediately, it's good to have, capital available.
Absolutely.
And then from an administrative perspective, I mean, Meagan, you can tell me if I'm wrong because I'm not a manager, so I don't have to deal with this. But we have buildings. We've seen buildings where they'll go out and open an account with U.S. Bank and U.S. Reserve Bank and this bank and that bank, and they'll have multiple accounts to to obviously keep under FDIC insurance limits, which obviously, if you go back to the beginning of this year, was something that we that we saw as a concern. But many times board members come off, they're the signatories, they leave the building. In some unfortunate situations, people pass away, and then you can't get that money. I think there's a lot of success I've found with using a brokerage house that works with co-ops, whether it's Merrill Lynch or Morgan Stanley, Raymond James, whoever it might be, Wells Fargo, and to set up all of your staggered CDs within that brokerage account, so it's all in one place. You can look at one statement and see your positions. And it also helps your management company manage the money, and they're not trying to collect multiple bank statements. When we're doing our audit at the end of the year, many times with the buildings that do this, we can't get a bank statement because it's being sent to the old managing agent because someone forgot to change the they did 7 out of the 8 bank statements, or there's a lot of banks also that if it's stagnant, they'll stop sending statements. I know Citizen Bank, Santander Bank will do that. And then if people forget about it, the board changes the change in property management, and then it's impossible to get the statements. And then sometimes we've even had situations where they send the money back to the state, and now you have to go get unclaimed funds from the money that you could have just kept in altogether. So that's just more of an administrative tool. That if you're going to do this, try to keep it all in one place if you're comfortable doing so. So it's not all over the place.
It is interesting you said that. That was one thing I had just jotted down, that keeping up on the signature cards when there's a changeover in officers on the board, to make sure that you always have access to your money and information. Because I know when you go to do an audit, you want to have the year-end statement. It's important to have somebody who has access.
Yeah, 100%.
Excellent. Okay, now we're going to move on to just general best practices. I guess Meagan, if you want to get us started.
Sure. We find it really important that you have your budget in time to make decisions before the end of your fiscal period. If you have a calendar year end of December 31st, you really need your budget in your hand by the end of October, so that you have a draft you're fairly comfortable with by your November meeting. If you're much later than that, it's not going to do you much good if you're trying to do a January 1st increase. So it's important to start early, even if your management company has not given you a draft by the middle of October. It doesn't mean that you can't start the discussions even on the items we talked about before, the potential one-time items, or what kind of financing you plan on doing if you have projects coming up. Things like that. So as property managers, we want to make sure we give the board enough time to ask questions, and then notify owners, hopefully 30 days in advance of any changes.
Excellent. Yeah, plan early. Avi, you wanna take it away as far as having a capital plan and referring to it while budgeting?
Yeah, I think we've probably talked about it a few times already, but the main focus of getting those increases in for the beginning of your fiscal year is on the operating side. Take the few minutes or however long it is. If there is a lot of managing agents will put in a capital budget section into your budget. Make sure to look at that and refer to it. Last year we had $2 million budgeted for facade. We didn't end up doing the project for some reason, whatever it might be, or the delayed, whatever the reason was. And now, now that becomes a 2024 capital budget item. Let's update your budgets. Make sure that, like we talked about, you're looking forward, if you can, for the next couple of years, I'm not going to necessarily, everyone needs to go out and get a one of these engineering studies that, you know, costs a lot of money, but look at, you know, the useful life of your bigger components and look at that as part of this process as well.
Excellent. And yeah, just to build on that, that is something that we do at AKAM. We provide, I know, Chris Alker, who's in our operations department, he provides Meagan's department with exactly what you said, just a useful life report. What is the useful life of various, you know, building mechanicals, things like that, just so that our boards know how to plan accordingly. You know, hey, you can get 5 more years out of this boiler, you could get 3 more years out of this. And it just helps with planning. As far as best practices, there I actually had a few things I wanted to throw in and ask you guys. I know we mentioned briefly, we glossed over flip taxes. What's your opinion? Good, bad, indifferent?
I mean, I think it's one of those, again, it's one of those items where if you have it, I've only seen positive for the building from planning for capital. The hard part's always, if you don't have it, getting it implemented. And there's many ways to do that. You know, someone will say, I've been living for 30 years. I was planning on selling next year. Why should I get hit with a flip tax? Valid point. I would say the same thing if I were you. So there's ways to grandfather it in that if you've been here for over 20 years, you're not responsible, or you have a lower percentage, however it might be. There's ways to make it that the whole community benefits from it, and people that have been there for a long time aren't going to get hit with it. But it's really, especially if you're a bigger building and you have at least 10, 12 turnovers a year, it's money that you're able to allocate towards capital for the future. And it's something I think most buildings are doing them. So it's not like I think maybe 15, 20 years ago was maybe 50-50, or it wasn't the norm, but most buildings I think have implemented some type of flip tax or transfer fee on the percentage of gross sales, and that helps build reserves, and you could plan for those things. I think it's helpful. If you have a smaller building that's like only 10, 12 units and the turnover is every couple of years, is it helpful to have one? Yes, but you're not going to get the same benefit from it, because you can't rely on it as much as a bigger building.
Excellent. All right. Okay, Q&A. I saw a few questions come in during the presentation. Here's one that I'd like to throw out there. Do you recommend a fixed term traditional mortgage for refinancing or balloon mortgages?
I don't want to step in. I don't want to step in front of Meagan because you didn't say who, but
I think it depends on the board's goal of,
yeah.
I've seen boards that want to be done with a mortgage in 15 years, so they'll take a fully amortizing. I have other boards that refuse to do any kind of principal pay down, so they have determined to be interest only forever. It's really the goal of the board. What do they want to see at the end of the term of the mortgage?
Yeah, and I think if you're in a co-op in Manhattan, condos are different, but with co-ops, I mean, it's your way to leverage financing for projects, and it's your only way to do it. So if you're going to lock yourself into a 30-year mortgage today, you're going to take out, let's say, $2 million. That's going to run out in 10 years. What are you doing from years 11 to 30? You're going to go take out a second mortgage. And so I think there is I don't think for most buildings that are in that, let's say, even 30 unit to thousands of units, anything above 30 units, it's beneficial to have it that you have the opportunity every 10 years to look back and look forward and say, all right, it's a reset, it's maturing, we need X amount of money for this project. Let's finance it, increase maintenance a couple of points, and move on. Whether or not it should be interest only or principal and interest that's a different conversation, which I don't know if we have time for it now. So we'll skip that.
Yeah. We also, by the way, we don't want it to be financial advice. We don't want to.
Yeah. Every building's different, so it's
disclaimer. Exactly. Yeah. We're not investment experts. Yeah. Here's an interesting one that came through. Should an amount of annual maintenance be included to increase reserves, or does that make maintenance too high? I guess yeah, what the person's asking is should you factor in increasing your reserves, or just, you know, covering your operating expenses with when it comes to your maintenance, your building's maintenance?
I think that goes back to the planning of what's coming up in the next few years. If you've just done a whole bunch of large replacements of, you know, building components, and you don't foresee anything, you might be able to get away with, you know, reducing that reserve contribution in the next year or two. But you know, I'm always a fan of having a line item there and putting away money for the future. So, you know,
Yeah,
that's
and I
my
think,
take
and
on it.
I think also, I actually got a call today from a property manager. You know, banks want to see that in the budgets too. They want to see, you know, especially in the condominiums, they want to see that there's a piece of the budget going to reserves. Does it need to? Meagan mentioned it before. Does it have to be the full 10%? Maybe not yet. I mean, it's something to aspire to. But it is a helpful, if you're a bigger building, it does accumulate, and it doesn't have that much of an impact on maintenance to do that. But it's important because of the banks. They're looking for that when people are selling, buying, and then also the buildings are refinancing. They want to see that in the budgets.
See, good planning, yeah. Okay, there are some questions here. Can condos implement a flip tax?
Yeah, they don't call it a flip tax, but there is something that they can implement, like a fee.
And then I got a bunch of questions, I guess, because we brought it up. I got a few questions. What's the typical percentage of a flip tax? Who pays it, seller or buyer? It's typically the seller that pays it. And then as far as a typical percentage, I mean, I've seen
1 to 3,
1 to 3%. Yeah, 1 to 3% of whatever that price increase was. And then here's
And that does depend on the board policy. We do have some that are dollars per share.
Right.
You know,
and then you have some that are based on the profit. So if you bought 30 years ago and it was worth X and now it's worth Y, you pay a percentage of that growth, which could be great for the building, terrible for the person selling.
If a board member comes to you and says, a new board member comes and says, hey, we haven't had a maintenance increase in 8 years. We haven't had a maintenance increase in 10 years. What's your reaction? Positive, negative? Avi, I guess I see you smiling. Take it away.
It can't, listen, it could be a positive thing that they've found the secret potion to not having to increase maintenance over 8-9 years. I find it hard to believe any building in Manhattan would be in that boat. They could have commercial income that's just blowing it out of the park, and they sign a great lease and they're paying and they're a great tenant, so that might be the case. But if you don't have commercial income and you're in Manhattan and you don't have all these other sources of revenue, I would check the financial statements to make sure that you're not running an annual deficit, because that's it's with the increases that we have in expenses each year. Maybe if you're a non-union building, that would be the case, but even so, everything else has gone up to offset it. So I would be concerned, make sure that's happening, because you might just get hit with a 10 or 12, 15% increase, 20% increase, the following year. Something might be coming up.
Meagan, anything you want to add to that? Because I know we've been asked that before.
Yeah, sometimes I'm skeptical that buildings that haven't had an increase in 9-10 years, if they haven't been overcharging for a portion of those beginning years, how are they able to sustain ongoing typical increases without increasing? They either had started overcharging, or like Avi said, maybe they're eating away at reserves to cover operating. Either way, it's not necessarily considered best practice. We like to recommend aiming for small increases over time or appropriate increases, as you look at the expenses and go line by line.
We got one question that I've gotten before. This is a very broad question, but what are the anticipated real estate taxes for next year? Or how can we follow this? I guess this attendee, she wants to know, just, is there a way to anticipate what property taxes are going to be for next year? Any way to get ahead of that?
Well, in New York City specifically, the assessed values come out in January, and the city bases the taxes on a 5-year average of the past 5, an average of the past 5 years times the rate. So some of it is pretty known going into your budget season. So there's a good chance that you'll be fairly accurate, but it is always good to have someone check with the tax certiorari attorney to make sure that they haven't been successful in getting you money, or something's happened in the meantime. So it's definitely a good idea to check with them. But yeah, we have a good handle on what your assessed values are and what the rates are.
And you said it, you said the magic words: tax certiorari attorney, petition your taxes, try to get them lowered. That's something that we do across the board at every building that we manage. I guess here's one last one that I think we could answer pretty quickly. What is the best metric for setting a limit on the size of the mortgage we take out?
That's a good question. So I think I had heard from some mortgage brokers when we're talking in the last couple of years. But obviously, is the question, how much can we take out, or what's the
how much
should we take out, is based on your needs, obviously.
Yeah.
The question is, are you over is your debt to income ratio so too high? And the answer really is based on the values of the units. And I was told that a lot of the banks look at, what's the value, 4 times the, mortgage, I'm sorry, 4 times the mortgage per unit. So if you look at, say, take a building, $10 million mortgage, 100 units. So you take that mortgage per unit and multiply that by 4. So let's say $400,000 in this case. Are the units in the building over $400,000? If you're talking about a Park Avenue unit building, probably yes. Different areas or different or would have different metrics. But kind of take a look at your mortgage per unit, multiply by 4, and you would see if you're overdrawn, for lack of a better term, on your on the mortgage. But I think the values of New York City real estate are so strong that I've rarely been in a situation where I've told the client, I think you've taken out too much money.
Absolutely. But you did say a magic phrase there, which is borrow what you need,
Right.
Take out what you need. Don't. And you shared that one anecdote of that building that borrowed way more than they needed.
Right.
All right. So we're coming up on an hour here. I think we've covered everything, but if anyone who's attended, I see we still have several attendees here. If there's any topic, any questions that we didn't cover that you would like, you have a follow-up question on, please don't be shy. Everyone's contact info is up here on the screen. And if you have any topics, any suggestions for future topics you'd like us to cover, please feel free to reach out to either myself or Meagan, and we would be happy to oblige. And that's pretty much it. Thank you, everyone. Thank you, Avi, especially for joining us today and sharing your expertise and knowledge. And we look forward to the next one.